Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. Markets seem to be treading water. Bond yields are not as high as many thought they would be, given recent inflation data, and equity markets are not posting the gains they saw earlier in the year. One reason could be that the economic recovery is faltering, and that is indeed something Dominique Dworfrico argues in a recent piece published at macrohive.com. We also feature a bunch of pieces ranging from what movie box office grosses are telling us about reopenings, the state of India's economy, and how cities are changing since the pandemic started. You can access all of these pieces by becoming a member at macrohive.com. This also gives you access to our entire archive of research notes and to our member Slack room, where the Macrohive team and members discuss markets all hours of the day. It's refreshingly different from Twitter. And when you sign up, the first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macrohive the hidden gem for investors. So once again, sign up at macrohive.com. And if you're interested in our more high-octane research product for professional and institutional investors, drop me an email on bilal@macrohive.com. That's bilal@macrohive.com. We're also proud to have masterworks.io sponsor this episode. There was a recent Bloomberg article showing average prices for NFTs have tumbled almost 70% from their peak in February. And if you're anything like me, putting your money in real tangible art by established blue chip artists makes a lot more sense. That's where masterworks.io comes in. Masterworks.io lets you invest in physical blue chip art by top artists like Monet, Basquiat, and Picasso via SEC qualified reggae offerings. From 1995 to 2020, contemporary art prices rose 13.6%, had a lower loss rate than gold, and a 0.01 correlation factor to equities, the lowest among the 10 major asset classes. There's a reason why 84% of the ultra-wealthy collect art. It's been a great way to diversify your alternatives portfolio while hedging against inflation. So head to masterworks.io today to learn more. And Macrohive listeners can skip the 10,000 person waitlist and see important information at masterworks.io/disclaimer. Now, on to this episode's guest, Charles Goodhart CBE. Charles is Emeritus Professor of Banking and Finance at the LSE, having previously been its Deputy Director. Before that, he had worked at the Bank of England for 17 years, including as Chief Advisor, and later in 1997 as independent member of the Bank of England's new Monetary Policy Committee until May 2000. He even has an economic law named after him, Goodhart's Law. He's written numerous books, including most recently The Great Demographic Reversal, Aging Societies, Waning Inequality, and an Inflation Revival. Now, onto our conversation. Welcome, Charles, to the podcast. I've been looking forward to this for a while. You've long been a researcher and writer I've long admired. So welcome to the podcast.
Thank you. Glad to be here.
Great. And before we go into our more sort of meaty part of our conversation, I wanted to ask you about your history, your personal history. And we can maybe start all the way back to when you started what you studied at university. And did you at that point know you would go on to become an economist? Was that your ambition at the time? And perhaps some of the highlights of your career since then?
Okay, well, it's a long story. I was the youngest of three brothers of an American father who came over to England after World War I, became the first American ever to become the master of an Oxford college. And of our three sons, the eldest became a politician. My father wanted him to become prime minister, which he didn't do. The older brother was actually the cleverest of the lot of us, and my father was an academic jurisprudence lawyer, and he wanted my elder brother to follow in his footsteps and to become an academic, which he didn't do. He became a practicing lawyer, and I was supposed to go into the family financial business. So when I went up to Cambridge, it was suggested I read economics. I'd been a historian up to that. And I found, actually, rather to my surprise, that I was rather good at it. And it was the first thing I'd ever got a first at. So I got a first at economics, and then I decided, well, I like it. I seem to do it well, so I'll stick with it. And after Cambridge, England, Trinity College, Cambridge, I went over to Harvard to do my PhD, where I did PhD actually on a historical subject as well. I came back to Cambridge. The then head chair of the economics faculty, I was an assistant lecturer, said that he would only recommend me for tenure if I became secretary of the faculty, which was a horrible administrative job. So I took the first decent job out. That was in 65, which was to become part of George Brown's, not Gordon, George Brown's Department of Economic Affairs. And from there, I went to London School of Economics because I'd been a sort of monetary historian, and Professor Richard Sayers was the doyen, the head of sort of monetary historians at that time. And then I was asked to go into the Bank of England. The Bank of England at that time had a system of asking young monetary economists to go into the bank for 2 years. And I was very fortunate because it was the beginning of monetarism. And I'd actually met Milton Friedman. I'd been at some of the discussions between monetarists and Milton Friedman and Jim Tobin, and I knew what it was about. There was nobody at the Bank of England who had any idea what monetarism was about. So I could explain monetarism to the bank, and I could explain the bank and what he was trying to do and what he wanted to do to monetarists. So I found myself at a quite young age, actually quite indispensable for a time in the bank. So I stayed. And I stayed very happily from 1968, when I went into the bank, until 1985, becoming a chief advisor along the way and doing a variety of exercises, including going off to Hong Kong to advise them on the link between the Hong Kong dollar and the US dollar. Then in 85, there was an opportunity for me to become effectively the chief economist, but the appointment and promotion went instead to my very good friend, who was slightly younger than me, and excellent economist, John Fleming. So I said to myself, well, John's younger than me, he'll be in that position perhaps forever. So I better do something else, because I didn't want to just go on doing the same old job. So I went off and took a chair at LSE again and founded with Mervyn King the Financial Markets Group in 1986, and remained at LSE as a teacher and professor until 2002 when I retired. But I didn't give up work when I retired because I enjoy economics and I continue to work there. And so I still work at economics and I still have an office at LSE, and I hope to go on working as an economist with a historical bent rather than a mathematical bent. Economics is a lovely mixture of history and maths. At the moment, I think that history is too undervalued and mathematical modeling is perhaps a bit too overvalued, but that's my prejudice.
Yeah, that's a great story, and you've had quite an accomplished career in economics so far, and you continue to have one. So that's really good. One thing before we plan to talk a lot about demographics, which is off the back of your recently published book. But before we do that, you touched on monetarism, and you said you were involved in kind of the early period of when that was entering the mainstream of economic thought. I mean, what's your view on monetarism today? Because obviously, it kind of had its heyday, you could say, in the 60s, 70s, and perhaps early 80s, and then since then it's kind of fizzled out a bit, or not fizzled out, but it hasn't been as sort of dominant in the discourse. I mean, do you have a view on the role of monetarism today?
Yes, my own research, which actually got published in probably one of my more important early papers called The Importance of Money, there is a really quite stable demand for money function, which means that velocity isn't going to move around too far, except in really extraordinary circumstances, and the COVID pandemic is one of those. But I was always an opponent and disbelieved in what is known as the money multiplier, where there is a stable relationship between the monetary base, the reserves that the commercial banks hold with the central bank, and the total broad money supply. And what unfortunately has given the rest of monetarism, much of which I think has got a great deal of sense to it, what has given the rest of monetarism a very bad name is that the shift in the operations in money markets from having the reserves held at the Bank of England have a zero interest rate to having the reserves held at central banks earning interest broke entirely the relationship between the monetary base and the broad money supply. And particularly the monetarists in the USA simply did not realize this. And in 2008, 2010, when the reserve base of the money supply increased dramatically, but the broader monetary aggregates did not increase strongly. The US monetarists like Alan Meltzer went around saying that hyperinflation is coming tomorrow. And of course it didn't, because the money multiplier collapsed. And that, in effect, has put what is valid and what is correct and what is interesting about monetarism, it has also put that very much in the shade. So most central banks now give hardly any concern with or interest in what is happening to the broader monetary aggregates, which in the last year or two has actually been phenomenal. And the rise in the broad monetary aggregates, which was not present in the period from 2008 to, say, 2013, has now really been, in many countries, dramatic. It's been as fast or faster than happened, for example, in the major world wars. And in the view of many of us, it's not going to lead to hyperinflation, but it's going to lead to much more inflation than the mainstream view in central banks now expect.
Yeah. I mean, I guess one kind of question, issue with monetarism or looking at monetary aggregates is how we define what money is, because that's been one of the challenges, because lots of the lines have been blurred between like money market funds to deposits to shadow banking to just the sprawling kind of areas of money. And then the other aspect of this is there seems to be, in relation to inflation, there is a possibility that lots of this kind of excess money that exists goes into financial markets rather than the real economy. And so say the broad monetary aggregates expand, is it ex ante, can we say that it will necessarily go into the real economy and then drive inflation higher, or equally it could just go into equity markets or property or something? What do you think about those two kind of?
Both those comments are absolutely spot on. And it has been one of the great weaknesses of any form of monetarism that the nature of money tends to change over time. There are ways of dealing with it. There's an economist called Barnett who's developed a Divisor monetary index, which is less prone to that kind of bias and distortion than most other estimates of money. And there are ways of dealing with trying to estimate moneyness, but that money, or rather the nature of money, does change to evolve over time, is undoubtedly correct, and one does have to adjust for that. Your other comment is that the relationship between money is closer with the financial variables than it is with real variables, is also absolutely spot on. But I think it raises the question of, if that is so, if monetary variables tend to affect financial variables more than real variables, why are the targets for monetary policy are real variables rather than financial variables? Effectively, what is happening is that your monetary variables are affecting things like housing markets very much at the moment. And we've got a synchronized house price boom going on more or less everywhere in the world, which is undoubtedly quite largely due to monetary policy. We got a lot of financial variables at what appears to be very high asset values. Some people talk about bubbles. And yet, until fairly recently, the real variables haven't been doing much. So the monetary policy has gone on more and more expansionary. And with the tax and other benefits of debt rather than equity, it has meant that we've started to work our way into a world in which debt ratios, both public sector debt ratios and non-financial or financial debt ratios, have been, in many cases, remarkably high. Not in all cases. For example, the countries which had a housing crisis in 2008, 2010, the private personal debt ratios have not risen to the same level. Germany has had no real increase in debt ratios, but they're the exceptions rather than the rule. And having monetary policy focus on real variables, which is only tangential in affecting, rather than financial variables which it affects directly, is, I think, a sort of really rather fundamental point. And the progress that we've developed whereby in order to try and bring inflation subject to many strong disinflationary forces, which our book talks about, back to sort of normal levels, has led to progressively, continuously easier, laxer, lower interest rates, increases now in monetary aggregates, which has led the debt ratios everywhere to increase to such an extent it's actually going to be quite hard to get out of the debt trap without either provoking inflation or interest rate changes, which might lead to a recession and even perhaps a financial collapse.
Okay, no, they're all very sort of valid points. And, I know we're kind of veering off topic here, but, we have seen recently central banks have been changing their targets. So, for example, the Fed now has their flexible average inflation target, and presumably the ECB will soon follow along those lines. So there's this idea of targeting price levels in some level, or inflation catch up, make up policy. From what you're saying, it almost sounds like your preference would have been to broaden the targets of monetary policy towards financial variables and kind of broader array of targets rather than necessarily just focus on the adjusting inflation targets. I mean, is that a fair characterization?
Yeah, it is. It's a very difficult subject because, and historically and traditionally, and in my view quite properly, central banks and monetary phenomena have always been required to have the stability of the internal and external price level very much at their center. But that said, I do think that a greater attachment somehow and to some extent to more financial variables and asset prices, particularly in housing, would be desirable, which means that if you're going to give more weight to housing prices, you've probably got to have a greater role for fiscal policy in assisting monetary policy in the maintenance of generalized stability of the prices of the standard consumption variables.
Yeah, understood. And your view on this average inflation targeting or some kind of catch-up policy, I mean, do you think that was a wise move, or do you think that was...
No.
Okay.
It was not a wise move.
Why not?
It was sufficiently dodgy that the Fed very carefully has never, ever specified over what period it was averaging and averaging which particular price index. What is more, in my view, the blip in inflation that is currently developing, notably in the US, but to a lesser extent in the UK and probably to even a lesser extent in the EU, may drive inflation up to such a level that most of the previous undershoots will already, by the end of the year, have been reversed. And it wouldn't surprise me is that if you took the US CPI and you took any reasonable back time period, you would find that by the end of 2021, the whole of the previous undershoot will have been almost entirely reversed by the scale of the blip in 2021. And since, in my view, the inflation will continue in 2022 and 2023 significantly, but not all that much above the target of 2%, does that mean that average inflation target in the US will require the Fed to aim for a target level below 2% in future? Now, what's this space? Basically, it was a silly idea introduced to deal with what was perceived as a particular concern of the moment. And I think that they were sufficiently disturbed by what they'd done to the extent that they've never communicated to the world at large over what period they are going to average and which index they are averaging. Talk about not communicating fully.
Yeah. And if you listen to Fed speakers around this subject, they all seem to have a different interpretation of what average inflation targeting is. There's no consistency in even what the Fed members themselves are saying. So there is this ambiguity, which probably does go back to what you're saying, that this was kind of almost like a regrettable move by them.
Yeah, and the thing, And I feel actually rather sorry for them in the sense that the COVID pandemic and getting out of the COVID pandemic are events which have had really no real precedent. To that extent, we're all flying blind to quite a considerable degree. When you're flying blind, it is not a good idea to lay down a new strategy or new set of tactics, because you don't really know whether your new tactics or new strategy will fit an unprecedented set of occasions. And because everybody tends to mimic the Fed, and the ECB is in the process of trying to devise a new tactics or strategy, just don't do it. Wait 2 or 3 years until something approaching normality returns, and then think about the longer term.
Yeah. And then, of course, we have Goodhart's law as well, in terms of whatever you target, it's going to stop working.
Yeah, well, alas, it works only too well.
Yeah. Now, I really did want to talk about your book, The Great Demographic Reversal, because it's a topic, demography, which, one, I think we don't really discuss enough. And secondly, it's not as well understood. There's kind of simple heuristics people have around demographics, which often aren't backed either by theory or by data. So I wanted us to kind of focus a bit more on that. And, one of the things I found in reading your analysis was the importance of understanding China and what China has done to the global labor supply, and how that in some ways kind of gives us a lot of clues in trying to understand the demographic trends we're going to have in the next sort of period of time. So perhaps we can start with China then. I mean, in terms of how you view China's impact on the global economy, and then we can kind of go from there.
Well, let me start with a couple of facts. First, China has been the largest country in terms of population in the world. I say has been because its decline in the birth rate, spurred on by the one-child policy, is about to make Chinese population significantly decline, while India's population is still very much on the rise. So China's role as the most populous country by quite a long way in the world is eroding and may reverse within not too far distant the future. Second point I would make is that China was undoubtedly the most advanced and leading country in the world for millennia until about the 17th century, when the Industrial Revolution began in Europe, notably in the UK. And that means that China has a remarkable history, and it has a history of being able to manage a very considerable system. In my sort of simple world, growth is really a function of good governance and education. And the Chinese population have been well educated, increasingly so in recent years. And whatever else one may think about the communist leadership, they have, at any rate since Chairman Deng, have shown a remarkable ability and aptitude to press forward quite single-mindedly to return China to its former position as if not the leading economic power. And they have, in that sense, effective governance and good education. And unless they make some terrible mistakes, they are likely to remain one of the leading economic powers in the world for a very, very long time. And the growth of China over the last 40 years has really been the dominant factor in the world as a whole.
Yeah, absolutely. That makes sense. And then in terms of how that maps onto demography, you're kind of making a point that we're at some kind of important reversal point globally in terms of demographics, whether that's China, whether that's the Western economies and so on. Can you kind of elaborate a bit more on that?
Well, actually, we're past it. The turning point was about 2010. And it was then really that the world's working age population peaked and began to start coming down, particularly in the advanced economies. And it was then that life expectancy started to rise so much, and the retirement ages did not rise alongside, so that the ratio of dependents, particularly elderly dependents, to workers began to increase very sharply. And the elderly are much more expensive than the young, not because they actually consume more, but because they get persistent diseases, particularly neurodegenerative diseases, which need a great deal of Medicare, medical support, and actually human care, human assistance. And those are both very expensive in terms of public sector expenditure.
And so you've said the reversal's already started. And, I guess one of the challenges with looking at demography is it's a slow-moving variable. Yet we can relate these demographic changes to growth. There should be some kind of impact on growth and also on inflation, presumably. So how do you kind of relate the two together?
Well, if we're talking specifically about inflation, the effect of the massive increase in working age population and the fact that women ceased to just do housework and actually joined the labor force meant that over the last 30 to 40 years, there's been an absolute explosion in the availability of workers for anyone who can shift their production from high wage to low wage centers, particularly to China. And China has become the manufacturing hub of the world. And that has meant that the bargaining power of labor in the Western economies has actually been trashed. And when your bargaining power goes down over a period of 3 decades or so, 4 decades really, it means that it's going to cut back on wages and the availability of labor. This massive, huge, long-term upward shock in the availability of labor has meant that inequality inevitably has increased a lot within countries. But actually, overall, world inequality has declined because the improvement in Asia, the most populous part of the world, has meant that between country inequality has declined much more, in effect, than within country inequality has increased. And in the old days, if you wanted to know where you were in the world's inequality pecking order, you actually only had to ask, where were you born? And if you were born in France or Canada or the US, more or less by definition, you were in the top 20%. And if you were born in India or China or Africa, almost by definition, you were in the bottom 40%. Now, that division by country is no longer anything like as strong as it was earlier. There's some very good work by Milanovic on all this, and I'm really to some large extent simply quoting the work that he's done. So that the inequality story is a very nuanced one. All the desperately poor peasants in China and Vietnam and Thailand and so on, and South Korea, are now, they're within striking distance of the poor people in the West. And that just usn't to be the case at all. But of course, the ordinary blue-collar worker in the West has done really very badly, while those with capital, whether human capital, technical skills or financial capital, have done brilliantly over the last 20 to 30 years. So it sort of swings and roundabouts. But actually, one of the aspects of our story is that the reversal of demography, and to some extent the reversal of the globalization that we've had in recent decades, is going to mean that within country inequality will actually itself start to reverse, and our countries will become gradually a bit more equal than they have been in the last decade or so.
And you sort of touched on one point in terms of this kind of abundance of labor that we've had over the last 30, 40 years, which has reduced the bargaining power of workers, which in turn has sort of depressed their wages. In relation to that, I mean, do you think this was to do with the fact that, there was this abundance of labor, or was it to do with politics? Or, I mean, I guess it's hard to disentangle these two, but there's been a big drive across the Western economies to break the power of the unions, reduce workers' rights, and make it harder for unions to form. There's been the growth of the service sector as well, which again tends to be less unionized. I mean, how do you think about these kind of other forces that have also, affected the bargaining power of workers?
Very good question, and they've both gone in the same direction. And we tend to think, and we've argued in our book, that it's basically the law of supply and demand that's had the major effect. In other words, it's been simply the massive availability of workers. But above that, we wouldn't deny that the attempt to specifically to reduce the power of trade unions has gone along in the same direction. But I think that we would argue that the inequality has also increased in those countries where the politics haven't been quite so anti-union.
Okay, yep, understood. Yeah.
And it's a good question, and it's a very good research area. How far has the reduction in the bargaining power of labour been due to just supply and demand, and how far has it been due to politics? And of course, the two interact. So trying to isolate the relative power of one or the other factor is extraordinarily difficult.
Yeah. And, in your book, you talk a lot about sort of the dependency ratio, so the young and the old are the dependents, and then you have the working age population. I mean, is there kind of a nuance between the young and the old? So if it's the older side of the dependents that's driving the change versus the younger side driving the change, does that have some kind of impact on inflation or investment and those sorts of things?
Well, as I said, the old tend to be more expensive than the young, partly for medical health reasons. And one of our greatest hopes is that we are wrong, because medicine will come up with cures for the kind of medical conditions which cause so much problem to the elderly. Dementia, Parkinson's, arthritis, and so on. And it may be that will happen. And if so, we will be absolutely delighted to be wrong, because basically our book is saying that there are going to be a number of problems in dealing with an aging society. And you have to be aware of what problems are likely to come. And because it's so slow moving, and the horizon of politicians, of economic forecasters, and so on, is only a couple of years, frequently at most. These kind of longer term issues frequently tend to be pushed under the carpet and ignored until it's too late.
And one of the classic case studies for aging tends to be Japan. And of course, Japan, when it comes to, say, inflation or even growth, has had a kind of a period over the last 20, 30 years of very low inflation, sort of verging on deflation at periods. And many people say that's due to aging. So because of aging, it's had low inflation, whereas you'd argue that that's not the case. Do you want to kind of lay out why you think the Japan kind of counter example is not actually a counter example?
For several reasons. One, Japan is right next to China, and there's what's known as the gravity theory, which says that you're much more influenced by nearby neighbors than you are by far away neighbors. And China is the nearby neighbor of Japan. And the Japanese firms saw the availability of cheap and effective labor in China, and they did a great deal of outbound FDI, establishing factories in China and other parts of Asia, and doing a great deal of their output there, with the result that manufacturing declined in Japan, and the Japanese workforce shifted from manufacturing to services. And the Japanese workforce shifted from full-time contract workers in manufacturing to part-time workers in services, where again their power was a very great deal lower. So Japan was effectively fighting or unable to fight the same disinflationary forces as we face. What we would say is a number of things. One is that Japan's QE never actually managed to get the monetary aggregates going at all far. The monetary aggregates in Japan have just begun to rise in the last year or so, and we'll see whether that makes a difference. They did their QE wrong because their QE was focused on Japanese commercial bank reserves, not on total monetary growth, not on broad monetary growth. So again, it was a problem with monetarism that it tended to make put much too much emphasis on the reserve base of the commercial banks, rather than on what was happening to the overall growth of broad money. Another factor is that the shift to part-time working has meant that the available unused labor supply in Japan is considerably greater than the raw figures of unemployment would actually suggest. And Japanese unemployment has always been remarkably low. And they've got a fairly large army of part-time, not fully used labor in the service sector. So in a sense, I think one would say that the demand-supply balance in Japan has not been nearly as strong as some of the simple data might suggest. The final thing I would say about Japan is that it's actually done very well in the sense that its labor force has been declining by 1% per year, whereas its output has been growing by 1% per year, which means that its output per worker has been growing by 2% per year, which is actually better than virtually any other country in the West. And countries like the UK and the US have had faster aggregate output, but considerably slower output per worker.
Yeah, no, that's a very good point. And I think a lot of people lose sight of that because we're so focused on GDP growth, kind of at the kind of absolute level. We don't look at productivity growth. So you're absolutely right, right on that. I also wanted to ask, in terms of the countries that we should start to see the inflation trend start to turn because of the growth in the rise of aging, presumably it's not just the US, it would also be Europe and China as well. So, one of the things is at the moment, the US is experiencing the highest inflation, perhaps some of it's COVID related and so on, but nevertheless, it's kind of the highest. And Europe is the other one where people tend to, say Europe is Japanizing in the sense that its inflation's been chronically low. But, with the demographic argument, presumably Europe should also see a sort of pick up in inflation because of demography, and same with China as well. So when you think about the countries to look out for where you should start to see this sort of trend move higher in inflation, how strong is the case for Europe and China?
Well, I think the case is strongest for the US also because of their policy, their demand policy, and their fiscal measures and their monetary policy have been really quite extraordinarily expansionary. I can understand the reasons why they do so, but if you interact that with a slowing working age population, we think that even after the short-term blip, inflation will remain significantly higher than they think. I think the same is true in China as well. Again, there is quite a blip in inflation and in prices coming out of factories in China and so on. Europe is different because it's had a much more restrained fiscal expansion and still a considerably more restrained monetary expansion than the US. And the power of trade unions and the power of labor generally has been lower. So I would expect the inflationary pressures to remain lower in Europe at any rate for the next few years, more because of differences in demand side policies than in the slow-moving trend effects of demography. But I think the demography will catch up with Europe by towards the end of this decade, but not in the next few years to anything like the same extent as the US and probably China.
Okay, understood. And in terms of the relationship between aging and real interest rates, real rates, I mean, is there a relationship between the two as well?
That's far more difficult. And I don't know. My colleague Manoj Pradhan tends to think that real interest rates will go up. I think that that's quite likely to happen eventually as a result of differences between savings propensities and investment propensities as aging gets underway. On the other hand, what we have is central banks at the moment who are certainly far from even regarding sort of our viewpoint as plausible. They are committed to holding nominal interest rates very low for as far ahead as they want to see. Now, the inflation blip is already driving real interest rates at the short end much further down. And I think that that is likely to happen for the next 2, maybe 3 years, that real interest rates at the short end will go down. If we turn out to be right and inflation is both much higher and more persistent than central bankers now generally think, then I think that this will feature and come into longer term interest rates, and expectations will change. So I would expect the yield curve to steepen rather. And if the yield curve steepens significantly, the decline in real interest rates at the short end over the next few years will be much less visible and might even turn into positive real interest rates at the long end. So the one prediction that we certainly would make now is for a considerable steepening in the yield curve between shorts and longs.
Okay, yep, understood. And, how do you think about countries that are not aging? So, if you look at the demographic projections for, say, India and large parts of Africa, those numbers seem to imply quite significant population growth. Could we see another China, in the form of India and Africa, come into play at the global level or not?
Well, one thing is, I think that the idea that the young population of either Africa or India will migrate en masse to the West, and it would mean a massive migration, is politically simply not in the cards. It's just not politically not feasible. That means that, like China imported huge amounts of capital and technical know-how from the West, you would have to have a great transfer of capital and technical know-how from the West to Africa and to a lesser extent to India. Now, some of that we think will happen, and we think that Africa and India will continue to do pretty well under the demographic dividend. The problem that we feel is that the ability to administer it is a great deal more difficult. Remember that China had a very centralized and economically efficient government. In India, you've got the continuing disputes between the central federal government and the states, which are frequently run by different parties. And even worse in Africa, with a population much the same as India, you've got 50 different countries. You've got a huge number of different languages, division particularly between Anglophone and Francophone Africa. You've got great difficulty in getting them to follow any centralized policies. You've got all the problems of borders, and you've got the problem of governance, and you've got the problem of dissensions within and between countries. And let me take an example. Ethiopia, until this last year or so, over the course of the last, I think, 8 to 10 years, has been one of the fastest growing African countries and had a tremendous record. And then you've got this internal fight between Tigray and the center. And that sort of internal fighting, dissension, whatever you like to call it, is going to set Ethiopia back quite a long way. And the prevalence of such concerns is, I think, really quite considerable. It's a question of governance. And if Africa could govern itself efficiently, without corruption, and in a way that was centralized, then it could become another China. As it stands, we have to say that we have our doubts.
Yep, understood. And how about automation and technology? Because obviously robots can replace humans in lots of different activities, and there's been the rise of AI and the rise of the digital economy has become larger. We've noticed that since COVID. I mean, is that something that could kind of offset some of the decline in the working age population, or the relative decline?
Well, neither me nor my co-author Manoj are experts in technology. We leave it to others. But we would say that there's a very great difference of opinion about those who work in that field. You've got Bob Gordon on the one hand, who says that all the low-hanging fruit have been picked and the technological advances will slow down. You've got Mokia and Björn Jolson on the other side, who say that digitalization and AI will speed it up. And the honest answer is, we don't know. It'd be jolly nice if technological advances do speed it up. One of the things about which we are absolutely determined is that robots are not the answer to old age care. What the old really want is sympathy, and they want human empathy. And the empathy quotient of a robot is exactly 0. And by the time you've had a robot doing exactly the same thing in exactly the same way, irrespective of how you were feeling, you're not very keen on it. I don't know whether you've ever had the misfortune to have been in a dementia ward in an old people's care home. And I think if you because you will, when you do have that experience, you will come to appreciate that robotics is not the answer. Robotics is the answer to getting rid of many rather dull, repetitive jobs in the rest of the economy, and that will have to release quite a lot of labor to actually help look after the old. The Japanese now expect that something like 10% of the workforce will have to be deployed to look after the old. They've also done their best to see how much robots and other automated devices can help with looking after the old, and they can to some extent. For example, a device that tells people when somebody has wet their bed, a device that enables an old person to be lifted out of bed into a wheelchair, out of the wheelchair into a bath and back and so on, is very helpful. But essentially what the old want is human sympathy and empathy, and that robots cannot give.
That's a very kind of fair point there. And I think that's an important point to make in regard to what problem is technology trying to solve. So understanding that's very important. And as you rightly point out, we need to understand what the needs are of the elderly, and some clever software, some clever robot just can't solve many of those problems. And earlier you touched on debt, and this is kind of how we can sort of round off our sort of macro discussion. Obviously we have very high levels of debt around the world, whether one looks at public or private or combine them together. And at the same time, interest rates are very low. So that's probably going to continue to allow these high debt levels to be serviced. But at some point, it can't be sustained, presumably, and everybody's been kind of looking for the big crash in something, because of these high debt levels. I mean, how can this high level of debt be kind of resolved in some way?
Well, I think it's very difficult. There are some suggestions for particularly shifting the relative fiscal benefits of debt as compared with equity. And we do mention 2 of these in our book, the ACE, the effectively giving an equivalent tax benefit to equity as is presently given to debt, and the border cash flow. I'm probably getting it wrong, but they're both quite difficult and quite problematic. And no Minister of Finance has gone very far. No, that's not true. They have in Belgium, but they haven't been taken up very widely. We do need to deal with reducing the tax advantages of debt as compared with equity. And I think that there are other steps that we need to undertake to try and make equity finance more advantageous to managers rather than debt finance. That said, I would add one thing, which is I do worry about the statements that central banks make that say, we know very easily how to reduce inflation should inflation take hold to a greater extent than we now think. Problem is that the debt ratios are already so very high that trying to deal with inflationary pressures by raising interest rates will be politically and economically much more difficult than the central bankers now evince. I'm reminded that some 20 or 25 years ago, if you'd asked almost any group of economists, can central banks increase inflation, they would have said almost to a man and woman, yes, of course they can. All they have to do is print a bit more money and inflation will return. Well, they tried, it didn't happen. Now they're saying, no, if inflation should come back, we know how to deal with it. It's not going to be a problem. I think the level of debt is already so high that it will be a problem and that they're being unduly complacent.
I mean, it sounds like we're going to have a rocky, next 5 or 10 years.
Well, yes, I have to say that I very much hope that the projections that Manoj and I have been making are incorrect, and that the mainstream view that everything is going to be fine, that inflation will remain low after returning back to target almost miraculously after the blip, and the interest rates can continue to be rock bottom for as far ahead as anyone can see. I very much hope that that's correct, because it'll be a lot more easier, it'll be a lot more attractive and pleasanter world to live in than the world that we see coming down the road. I hope we're wrong.
Okay, not many economists say that, and it's good for you to say that. But I did want to end by asking you a few more sort of personal questions. One is you're obviously very well read, and you must consume a lot of literature and so on. You read lots of papers. I mean, do you have a system or a certain discipline you use to keep on top of the latest research and the latest thinking in your areas of interest?
Yes, the world has moved on in terms of academic research and reading. One of the problems is that a journal publication usually takes now between 18 months and 2 years between submission of the article initially and it being published in the journal for all kinds of reasons. As a result, virtually everybody with a paper that they think might be publishable publishes it as a working or discussion paper in a series of outlets. The NBER, particularly in America, the CEPR in the UK, and the central banks all have their own working paper series. And I keep my eye on the weekly working paper and discussion paper series, and I read them, not the journals. Nowadays, getting your paper published in a journal is just a sort of a symbol that it has passed through the refereeing process. But anyone who wants to keep up with modern research goes to the discussion and working paper series.
Yep, understood. And finally, are there any books that have really influenced you over your professional life? Whether that's early on in your career or more recently, some books you thought, they're really sort of good, enlightening books that you've read.
I tend to read much more in the way of papers. I think the book that probably influenced me most, although I disagreed with bits of it, was the Friedman Schwartz Monetary History of the United States. Again, I'm a historian by training and inclination. I thought Barry Eichengreen's Golden Fetters was a brilliant book. Besides that, I think almost all of the works of both Dennis Robertson and Jim Tobin have been the economists and the analyses that have influenced me more than any other.
Okay, no, that's great. And actually, just a follow-up question on the Friedman Schwartz book on money. Why do you think there hasn't been other books on money that have been published since that book? Because it seemed almost like that was kind of the big sweeping monetary history book. And then we haven't really seen a similarly kind of book published since then. There's no one seems to have written a book for the last 40 years on the last 40 years of monetary history.
If I was younger, I'd take up the challenge and try and do it myself. Since I'm approaching 85, I think it's well beyond me. Oh, I don't know. There have been, and the splendid Kindleberger, which was taken on by my friend Bob Oliver, book on crises over the years, I think is another great book, which I recommend to anybody.
Okay, that's good. Okay, that's really good. And if people wanted to follow your work, obviously there's a book which I'll include a link to in the show notes. I mean, do you publish articles anywhere, or are there kind of other channels where people can follow you?
Well, they could look me up under Wikipedia. That's probably the easiest, simple way of doing it. It's the way I look up most people.
Great. Well, with that, I just wanted to give you a big thank you. It was a really excellent conversation. I learned a lot during this discussion.
Well, thank you. I've enjoyed talking to you. It's been good fun.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a glowing review, and let other people know about the show too. We'd be really grateful. Also, sign up to become a member at macrohive.com. We'll be back soon, so tune in then.